The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, welcome to BYIC webinar and thank you so much for coming. My name is Shane and let me turn on my webcam so that you can see me. Just give me a minute. Hi, this is me Shane and I'm the moderator for this webinar. And before we begin, just want to check whether you can hear us clearly. So if you can hear us clearly, could you please click raise the hand button on the control panel so to indicate that you can hear us. Okay, thank you. I'm seeing more hands now. Okay, awesome. Majority of you can hear me loud and clear. So yeah, you may put down your hand. Thank you. So we are doing this live, but of course we want to to save the bandwidth. I want to switch off the webcam so that we have a uh, smoother session. Now this is on the other end of the webcam. That's PC Wong, which is our speaker today. So we will
Hello.
switch. Yeah, thank you PC for coming. So we will switch off our webcam for now.
Okay.
Okay, awesome. So today, as usual, we have an amazing turnout of webinar attendees. Yeah, we are almost near the full house already. We feel very encouraged. Of course, our topic today is how to invest in value stock, which is something that I feel PC is really, really good at, and he's exceptional in this area. And by joining this seminar, this webinar, you will learn how to identify value stocks, how to invest in value stock, and we'll explore a few case studies on how you can employ the strategies that put forth by PC. So this webinar is approximately 19 minutes long and consists of two segments. The first segment is 60-minute content and is followed by 30-minute question and answer sessions. So, but the timing is tentative because sometimes we may have overwhelming questions, so the speaker may spend more time to answer the questions. Again, first thing first, disclaimer. Okay, now this all information shared in this webinar is mainly for educational purpose only. So, no, we do not want to give you any buy or sell recommendation. So of course, if you we dissect company on educational purpose, but in case you buy any stock or you sell any stock based on our discussion today, then you do it at your own risk. Okay, we are disclaim against all liability or if you make money, you don't have to credit me. Okay, you credit Bursa. Okay, if you lose money, of course, you are entirely responsible for that, right? So anyway, the series of webinars is brought to you by Bursa Malaysia and managed by us, LifeChamp. So these are a series of webinars we've done for the year, and now we're at session 7, how to invest in value stock. All right, so just allow me to introduce our speaker. PC has graduated from National University of Singapore in 1989. For those of you who have tuned in our previous webinar, PC name wouldn't be strange to you because he has been very helpful and educating the public on stock investing through a number of series of webinars earlier on. So he has more than 26 years of working experience with several public listed companies and multinational companies. He's a best-selling author of 2 books, in which one of which is Invest in REITs, which reached popular top 10 non-fiction seller. And he has been a full-time investor now and trainer and investing in Bursa and international markets since 1995. With that, I would like to pass the control to you. Yeah, PC. Just give me a minute. Let me change presenter to you. Yeah, take it from there, PC.
Okay. A very good evening to all listeners who are tuning in. So today we'll talk about how to invest in value stock. And there are a few things that we need to understand. One is the understanding the characteristics of value stocks. Then we learn the risks and rewards of investing in value stocks, learn how to identify value stocks, and learn the strategies to invest in value stocks. Now, what is a value stock? A value stock is a stock which possesses solid fundamentals, especially if we look at it financially, growth-wise, dividend payment, etc., while being priced below those of its peers. Now, very importantly, normally a stock is considered a value stock only when you are able to compare against the peers, preferably within the same industry. Okay, so to determine if a stock is a value stock, the metrics are measured against peers within the same industry. You have to remember this. And perhaps Warren Buffett is the most famous advocate in value investing. Characteristics of a value stock. Now, a value stock is characterized by the following. It must have a consistent growth in revenue and net profit, consistent dividend payment, consistent growth in return on equity, financially stable, lower price to earning ratio versus peers in the same industry, and lower share price over the net asset value per share versus peers in the same industry. Now, consistent growth in revenue and net profit, while we look at it, there must be consistent growth, but outside certain massive tremor within the financial market, such as the global financial crisis, Asia financial crisis, that company may not exhibit consistent growth, okay? But if you are able to identify such a company well in advance, perhaps during the financial crisis would be the best time to make a purchase of such a company, yeah, provided that is a balance sheet is very strong so that it's able to ride through the crisis. Now, there are risks in investing in a value stock, namely, because a value stock price could remain undervalued for longer than expected time as it relies on the discovery of its intrinsic value. Now, what is intrinsic value? An intrinsic value normally is a situation whereby the stock have reached a pricing that really matches its potential, okay, in terms of potential in the growth, okay, and also in the financial strength of that company. Yeah, so when that is reached, then that is called the intrinsic value. But that doesn't mean that that intrinsic value is a indication for you to sell, because normally when that particular stock becomes very popular, okay, there'll be more money moving into that stock. Yeah, and sometimes you may see a PE ratio that moves higher than the average. And then some of the risks, of course, is the cost of holding a stock for longer than intended period, because this will be an opportunity cost. So if you buy a stock that, for example, you intend to hold it maybe for 2 to 3 years, but then that company, is still languishing in a situation whereby there is not enough interest, okay, although it may be performing quite well, then what we have is that it will stay in a level whereby it will not attract people yet, okay, but sometimes if it has managed to attract a lot of investors, okay, then you will see an influx of investors, and then that stock will actually move up in terms of pricing. Yeah. Now, the price discovery may not happen overnight or swiftly, but gradually, each time forming a solid base from which a new leg to the upside will form. Okay. So in that case, you need to have patience. Yeah. Rewards in investing in a value stock. Now, the greatest reward in investing in a value stock is the eventual price discovery of its intrinsic value. Okay, that is when you will see that the kind of potential is priced in, its balance sheet strength is priced in, and such. Yeah. However, the price discovery is often gradual, but as more institutional investors pile into the stock, it can rise quite dramatically. Okay. The price discovery may be in multiples of the original undervalued price. So that's why when you want to invest in a value stock, you have to find a pricing, okay, that is very low, not to say very low, but low enough, okay, versus the peers, okay. And if let's say the peers have moved up while this stock is still languishing, okay, once it is able to perform very well and consistently, then eventually there'll be interest going into that stock. And because it starts from a lower base, the initial rise can be quite dramatic. While waiting for the price discovery mechanism to take place, it's very important that investors is able to rely on dividends as a reward for their patience. Now, if you want to invest in a value stock, it's very important that you select us, because the price discovery sometimes may take longer. So it's very important that you find a stock that is able to give you dividend while you wait over a longer period. Now, when it comes to dividend, of course, that yield, okay, should be a yield that you can, that is a reward for your risk. For your risk taking. So sometimes the yield, depending on the person, okay, you may be looking at a yield that matches the opportunity cost, okay, versus, for example, were you to put the money into a FD, okay, where it's around 3%, let's say. So you may be looking at a yield that matches that 3%, okay, or slightly lower. But if you can find a yield that is higher, then that would be even better. So very importantly, while you wait out the period, that particular stock must be able to give you dividend as a reward for your patience. Now, how to identify a value stock? You need to take into account, okay, the current economic environment, okay, because valuation of stocks in developed market is at highest level right now. There's also a risk of major correction, okay, because why we talk about the developed market in the US and EU, because right now their valuation is the highest near historic high, okay, and some of the markets in the EU and US have already reached record high levels, okay, so the risk is very, very big. And if let's say there's a situation whereby they have a major correction, it will spread across all the equity markets in the world. And that is why you need to look out for other markets as well, because when US and China sneezes, okay, the entire world will catch a flu, okay, and then the economic data coming out of the US and China is not encouraging right now, okay, especially in the US, okay, where you have a lot of lower wages as well as very mild inflation, despite the Federal Reserve targeting it at 2%, okay, and also the global debt is at the highest on record, equivalent to more than 330% of global GDP. So because of this debt level, if the market really falls, then the debt market implodes, then it will create a very severe tremor across markets all over the world. And Malaysia faces challenging economic environment, especially the disposable income of the consumer and the weak ringgit. This is in particular because the weaker ringgit has made the price of goods higher, and such a case that people can, when previously people can afford to buy 10 items with 100 ringgit, for the same items right now, maybe it will require 150, okay, or 160 ringgit. So that's why consumerism in Malaysia is being affected because of the weaker ringgit, which push up the price of goods. So this Malaysia's GDP from the World Bank, okay, and it's compared against Indonesia, 5%. Malaysia 2016 GDP was 4.2% and Thailand 3.2%. Now, for the same period, the CPI increased by 1.8%. Now, if we remove the impact of inflation, then the actual GDP is only 2.4%. So why I say we remove the CPI? Because the GDP is the price of goods paid, includes the price of goods paid. And if let's say inflation is pushing up the value of goods, therefore the GDP may reflect as a higher figure. But then that, in order to know what is the real growth, then you need to take out the impact of inflation, which is why if at 4.2%, if we take out the CPI, the GDP growth is only 2.4%, which is low okay, if you compare to previous years. Now, previously in previous years, okay, especially in the 1990s, Malaysia growth is almost at 10%, okay. Then we have the Asia financial crisis, okay, and then it moved up, okay, still on the high side or above 5%, okay, and then the dot-com bubble burst, okay, the dot-com bubble burst, and then it moved up again, touching briefly 10 before the global financial crisis. And then since then, okay, the GDP has not been showing much upside towards the above 5 level. In fact, it's trending down below the 5. So you can see that why it's important to monitor the certain aspects of the global market, because over here, this is the Asia financial crisis, okay. This is the global recession during the around the mid to late 1980s. Okay, this is the Asia financial crisis, which started in Thailand, then it spread over all across Asia. Okay, and then we have the dot-com bubble burst. Now, when the major markets fall, it will actually influence global equities as well, and that's why it pays to look at the movement, okay, of the markets outside of Malaysia. So this is the global financial crisis, okay. But since then, if you look at it, that the after it reached a height, okay, if we draw a straight line over here, okay, the GDP actually has been trending down, okay, mainly because that the ringgit is getting weaker, and that is why when the ringgit becomes weak, okay, it will impact upon consumerism, and consumerism on its part do drive the local economy. So over here, okay, back then, before the financial crisis, the ringgit to the US dollar was around 3.2, 3.3. Then during the financial crisis, it shot up to 3.6, and then it starts to trend down. And then recently, it's around 4 already. So that's why it's putting pressure, because the price of imported goods are becoming much more expensive. So in this case study, for the purpose of this
I just want to add on that the good news is that this year our GDP has turned up. Q1 is about 5.6%, Q2 is 5.8% for Malaysia. Okay, last year wasn't very good year, 4%, but this year we are slightly better, 5%. Yeah, which is something good to us.
Yeah. So again, the this is based on the 2016. Okay. So if definitely, if the GDP is of course, all of us hope that the GDP would move up to the back to the above 5% level more consistently. Yeah. So it remains to be seen how the later part of this year would show, because again, one of the major concern is that because the equities level in the developed market is getting very frothy. If let's say there's a correction, normally correction happens towards end of the year, yeah, like during the 2008 financial crisis. So if let's say there's a major correction, then it would actually impact the equities market as well. So we have to wait and see how it turns out this September and October. Yeah. So in this case study, we'll look at 3 consumer stocks using the measuring metrics that I've often used. Okay, we focus on Nestle, F&N, and Apollo. Okay, now this is a comparison of the 3 companies. You have a year-on-year growth. Okay, Nestle at 4.45%, F&N is down, negative -2.05. Apollo was up 0.35%. Net profit growth, Nestle pretty consistent with its revenue growth at 4.42. F&N dropped 9.5. Apollo was 40% down. Current ratio for Nestle is very weak, okay, at 0.8. Okay, FNN is 2.35, Apollo is 15.77. So when we look at the current ratio in this instance, Nestle would actually need to move, may need to incur debt, yeah, to balance up its current ratio or to reduce its dividend, yeah, because you know, normally our KPI is that it must be above more than 1.5, but in this case it's even less than 1. Debt to equity ratio, okay, the debt to equity ratio is very high for Nestle, it's 2.07, whereas FNN is 0.52 and Apollo is 0.09. EPS estimated because they have different quarters of reporting. Okay, Nestle is about around 393 cents. FNN is around 110 cents. Apollo is 22.29 cents. Dividend, Nestle is at $2.70, 2 ringgit and 70 cents. FNN is at 57 cents and Apollo at 25 cents. The share price is based on a couple of weeks ago. Nestle is at 84.2. FNN at 24.68 and Apollo at 5.08. Dividend yield, therefore, Nestle gives a dividend yield of 3.2. FNN is 2.33 and Apollo at 4.92. Net asset value per share, okay, is at 3.68 for Nestle, and therefore its share price versus its net asset value per share is 22.88. This is indication of a very high valuation, yeah, because it's 22 times its net asset value per share. Whereas for FNN, okay, net asset value per share is 5.76. Share price over net asset value per share is about 4.28 times. Apollo net asset value per share is 3.17. Share price over the net asset value is 1.6 times. Now the P ratio for Nestle is 21.42, FNN is 22.33, and Apollo is 22.79. Again, this shows more on the high side of valuation. Okay, change in operating cash flow, all of them are positive. Return on equity, Nestle looks the highest at 106%. Okay,
Are you sure it's
FNN at 19.
106%? It's too high, leh.
Because if you look at it, its equity is very low. That's why its that's why its debt to equity ratio is very high. The problem with Nestle is that its equity level is very low. So that's why when it's when you look at its profit, so when you look at its net profit over the lower equity, that's why it seems to give a very high percentage in terms of return on equity. But if you look at Nestle, there's a lot of red flags flashing all around because its debt to equity ratio is 2.07, okay, or 207% when you look at it in terms of gearing. So its current ratio, it doesn't even have enough money, okay, in its or its current assets is not enough even to finance a 12 months current liabilities. So what will likely happen is that either Nestle will have to cut dividend, okay, to balance up its current ratio, or it may incur even higher debt to balance its current ratio. So when you have such high debts here, your equity level would actually go down. And this is what happens with Nestle. Because of its high debt to equity, its equity, because equity is total net assets here. So that's why its net asset value per share is very low, because there's just too much debt in Nestle. So that's why when you have a kind of that kind of net profit, when you measure it against the return on equity, it gives a very skewed figure of 106%. But if you examine its balance sheet, it is all flashing red, yeah. Especially if you look at its share price over net asset value per share is 22.88 times, around 23 times, yeah. So that is this figure may look good if you are just looking at return on equity, but the rest are all flashing red, especially on the current ratio and debt to equity.
Yeah,
until Nestle is able to balance its, yeah.
Yeah, I mean, this is a
Go
income
ahead,
stock. That's why people are willing to buy it for dividend and then keep bidding out the share price.
Yes. Yeah, but if you look at it, its dividend yield is only 3.2%. So it doesn't mean much here. Where my opinion, of course, where you only get 3.2%, but then you are buying a share price that is so much overvalued. So it's just a matter of time whereby if Nestle need to balance its book, definitely they have to cut dividend, or they will continue to borrow more, and then therefore pushing down its equity level. But then when its equity level is getting smaller, that's, it's like instead of growing its equity, the equity is actually shrinking. Okay, then that's a danger sign already. So that is when here I would say that it has become very overbid where Nestle is concerned. But if you overbid for 84 ringgit per share for a stock for just 3.2% dividend, you might as well go for the REITs, which are cheaper. The REITs, they are just some are 1 ringgit plus, 3 ringgit plus, but you still get about 5 or 6% net. You see, so it doesn't make sense that why you should bid up, why you should invest in Nestle when its dividend is only 3.2%. And the rest of its balance sheets are actually, indicators are actually flashing red. Yeah. So in terms of measurement and KPI, okay, this is the kind of ratio that I use. Okay, so all the Nestle built in all the ratios. Yeah, FNN, because of his revenue growth and net profit being a negative, they didn't meet, but at least their balance sheet is good. Okay, dividend yield didn't meet this 5.5%. Now this 5.5%, I use it as a gauge in my metrics because there is a reason. If I'm looking at 5.5% dividend yield, if there's a shock in the market where the dividend would actually fall by, let's say, 20% or 30%, okay, assuming it falls by 20%, then it's less 1.1%. At least then it will still be around 4%, which is then will be likely double of the FD rate, which during an economic crisis would run at around 2%. So that's why often when I want to look at a dividend yield, I would want to measure against my KPI of 5.5%. But it doesn't mean that if the stock does not meet the 5.5%, it's not a good stock. Yeah, but this is something which I use as my own metrics. Of course, you can lower the dividend yield to the current FD rate, maybe 3.2. Okay, then maybe Nestle would pass, as well as Apollo would pass. But because when I do an investment, I want to look at something that how to survive in an economic crisis rather than based on current situation. Yeah, current situation may look rosy, but then if let's say the balance sheet does not will not provide that kind of financial stability to a company during a financial crisis, then what you will have is that that company could see its share price drop in line with also its equity, because they may need to sell assets to actually balance their books. So that's why oftentimes my metrics is gauge versus a worst, looking at a scenario which I want the company to survive in a financial crisis. Yeah. So in this case, Apollo has 3 years versus Nestle 2 years. Okay. But then when we want to analyze the whole thing, in this case, Nestle is not in consideration due to its low current ratio, high debt to equity ratio, and rich valuation, even though its ROE is far superior. Nestle risks far outweigh the positives in light of the current global and local economic environment. A spike in interest rate could be damaging to Nestle, and it may be forced to cut its dividend. Now, why I say that potentially there could be a spike in interest rate. Now, what we are seeing here is that some of you have followed me to previous webinars. I did mention that one of the things that you should look at is the what the Fed does with its interest rate. Now, assuming that the Federal Reserve would need to increase in interest rate, it will spread across all over other equities, spread over other economies, okay, where they may need to increase interest rate as well. Why do I say so? Now, if let's say the Fed continue to raise interest rate, US, then a lot of people may want to shift their money, okay, into the US, whereby they enjoy higher interest rate. Now, if let's say that happens, there will be a run on a lot of a run of money, okay, in a lot of economies, and therefore, when the US increase interest rate, some of the other countries would follow suit, okay. So recently, the Fed has been saying that they are going to increase interest rate. So my fear is that if the interest rate is increased, okay, then it may spread over to other economies. And in Malaysia, even our bank the ground may consider increasing interest rate as well. And if let's say interest rate is increased, then Nestle, because of its huge debt to equity ratio, they have to force to pay a much higher interest, okay. And if let's say they are forced to pay a higher interest and they have insufficient funds, then they need to borrow at a much higher interest to pay for funds that they borrow at a lower interest. And that is when it becomes very fragile for that company. And if the US dollar continues to weaken, okay, what will happen is that there may be inflation in the US, okay, and if let's say if US dollar continue to weaken further, inflation in the US, okay, would begin to move higher, and the Fed have to increase interest rate, okay, to match that. Now, there's a lot of, if you look at the US dollar index recently, from a high of 106 versus other currencies within the same basket, it has actually moved down now to about 92.3, 92.5 region. So the US dollar actually has devalued, okay, about 11% versus other baskets of currencies in the last 1 year or so. So that's why if the US dollar continue to weaken further, the Fed will have no choice but to raise interest rate, okay? Because a lower US dollar would cause inflation to spike up, okay? And if the US dollar continue to weaken further, it could cause hyperinflation, in which case then the Federal Reserve would actually increase interest rate at a much higher frequency, okay? So that's why, that's how precarious the global economy is right now. Now, the failure of all three in meeting the KPI growth target in revenue and net profit is indicative of a challenging consumer environment. Okay, so it goes to show that consumers are right now not spending as much. Okay, and that's why it's reflective in the revenue and profit areas where FNN and Apollo went into negative, while Nestle just marginally able to grow its revenue and net profit. So evaluating FNN and Apollo. Now FNN KPI score is 2 yes and 4 no. Apollo KPI is 3 yes and 3 no. Based on the data, I think FNN would be more favorable in the current economic environment due to overall strong brands presence. FNN actually have multiple brands with very strong presence in the supermarket. It has a stable balance sheet versus Nestle, consistent dividends since 2007, and a good ROE. Okay, not as extravagant as Nestle, because Nestle is because of sometimes we say financial engineering. Yeah, that when you have a low equity, then your return on equity suddenly shoot up. Okay, so that is why normally when I put certain KPI, okay, I would base it more on the things that are in the balance sheet, okay, rather than just comparing the PE ratio and return on equity. Now this you can compare with other peers within the same industry, but given the potential slowdown and higher PE ratio, why I say that the PE ratio right now, the valuation on these three consumer stocks is very high, because the FTSE Composite Index PE ratio from 2009 to 2017, fluctuates from a low of 13.22 to a high of 21.03. And if you look at it, okay, all three are actually on the high side, okay. above the band that the composite index PE ratio from 2009 to 2017. So they are now on a higher valuation. Okay, so that's why I wouldn't say that it's a buy right now, but I would deem FNN as a better option if a major correction takes place. So if you look at it, sometimes it's very important for you to look at what is the range of the PE ratio, so that you know whether that within that particular stock falls within that range, okay, that is or outside that range. Okay, so there are some the PE ratio statistic is from CIC data, okay, and dividend is actually from Malaysia stock.biz here. So we look at FNN stock price chart here. Okay, you can see that it is on a growth trajectory in terms of the pricing, where for quite a number of years, okay, from around 2006 to 2010, it was within the sub 10. Then from 2010 to 2016, it is in the sub 20. Remember what I say is that in a value stock, you have to really be patient to realize that kind of gain. Yeah. So if we look at it, previously it's around five ringgit or less. Okay, but right now it's trading at above 20 ringgit. Here we have it at about share price at 24.68. So then you are looking at a couple of multiple times in terms of returns. Yeah, if you hold for a very for a longer period, and then you see that there's really tremendous share price appreciation. And not only that, because they have been consistently paying a good dividend over the last since 2007, that will also contribute a significant percentage. Okay, so the stock is generally on an uptrend, but I would look at a price correction to the downside as an opportunity to purchase. I wouldn't chase the stock right now, okay, because as I mentioned, the global markets scenario doesn't look too rosy, because a lot of the valuation is very rich. So in case there's as a lot of economists are predicting, because of the uncertainties and the fear in the North Korea conflict, okay, there could be a pressure on the markets to move downwards. So in that case, I would look at a correction as an ideal opportunity to buy. Okay, now very importantly, why not Apollo? Okay, because Apollo, yeah.
How do you see the geopolitical risk and the potential financial meltdown that you described just now able to affect the defensive sector in Malaysia, such as the consumer staple industry like FNN, Apollo, and Nestle? Do you think they will be adversely impacted and affected by this,
I think,
global risk?
Yeah, I think however you see it, okay, any shocks to the global market, initially there will be a tick down on all stocks across the board. Okay, for example, over here in 2008, you see that it has reached a peak, but then as the problems becomes bigger, okay, towards the end of 2008, okay, it starts to fall, and this is also in line with the fall across the board during the global financial crisis. But then you see that it starts to move up, okay, around 2009, okay, it starts to move up again. So I would say that even consumer staple stock, they are very defensive. But if let's say there's a big hit on the global stock market, rest assured, okay, there will be a sharp correction on the downside. Okay, but then because a lot of people see consumer products and staples, yeah, especially FNN, okay, as a defensive play. So after the initial sell off, okay, then it will be a good time to accumulate, okay, and then you will actually see that people would move into consumer stocks as a defensive play, and therefore its fall will not after the initial fall, it will start to stabilize. Yeah, versus other stocks that rely on more aggressive growth stocks, for example, they may fall further than what the consumer stocks may see. Yeah, so this is something to look at. Okay, does that answer your question?
Yeah, definitely.
So yeah, okay. So of course, because Apollo has a better score balance, so-called scorecard. Why I do not give enough weightage to Apollo? Well, its net profit drop was staggering and also worrying. Okay, its ROE is weak versus FNN now, and there are some years which it did not pay a dividend. So very importantly, when you invest in a value stock, you do not know, okay, how long that stock would actually appreciate in price. Okay, for example, if you are investing during the few years here, the 2 to 3 years here, FNN is moving in a very tight range. Okay, before it start to breach the 10 ringgit, and then after the breach, it really moved up very fast. Okay, and then it comes back down again. So always look at it that there will be some years where that appreciation may not be significant. Okay, and it's very important that during that years, okay, you actually have dividend. Now, one thing about Apollo is because its balance sheet has too much cash and very little debt. Although definitely in a major financial crisis, Apollo would have no problem, okay, in surviving. Okay, but then when a company has too much cash and very little debt, it tends to indicate to me that the management is very, very conservative. Okay, and they are very and they do not want to promote risk taking. Okay, but when you don't look at taking certain risks, okay, you will actually fail to take advantage. For example, if let's say in a very low interest rate environment, if the management is very aggressive, they could have actually with such a strong balance sheet, they could actually have borrowed money and make some major acquisitions, okay, to boost revenue and net profit growth. So when you have so much money sitting inside the company, because its current ratio is 4 times it's 4.06. okay, that's a very high current ratio. Okay, you have a company that sits on this pile of cash, but they seem to be contented with where they are now. Okay, rather than using that amount of cash, and because of low debt to equity, to actually leverage on it to make a substantial acquisition, which then to boost revenue and net profit. But when that management is showing, when you see the management is too conservative, it means that they are just contented with where they are. And if let's say the share price were to appreciate, okay, it will be a very slow affair. Okay, and based on how people value their balance sheet, okay, without an aggressive revenue and net profit growth, then that share would actually be languishing while others have moved ahead much faster. Okay, so in that sense, I'm not so much in favor of Apollo. Okay, now strategies in investing in value stocks. First and foremost, it requires patience in waiting for the opportunity to buy when the stock is exactly undervalued, and in waiting for the price discovery to take place after to boost the stock price. Okay. This is very important. Okay, when you want to buy a certain stock, sometimes when we read certain news about that particular stock, then suddenly we feel the urge that, hey, this will increase its revenue. Then we suddenly decide that we should buy, but then without really looking at the overall context in terms of its balance sheet, okay, in terms of its potential to grow even further. Okay, so of course, while looking through Nestle, there were some analysts which say buy, but to me, well, it's very subjective. Okay, for me, I would look at the financial stability of a company first. Okay, and whether the amount of money that you put in, thankful for that. Okay, so rather than just go headlong and buy because other people are recommending a particular stock and so on, do your own diligence and measure that stock. If let's say, if that stock really is good, but then its share price is still overvalued. Okay, for example, in this case of Nestle, its PE ratio, is above the band of the last few years, okay, of PE ratio, then I would think that stock valuation is pretty rich right now. And I know that I have identified this stock, but I would not be, wanting to buy this stock immediately, but to wait for the opportune time, whereby if there's a correction, okay, it may make that stock undervalued versus its peers even further, okay, so that when there's price appreciation taking place, I know that I would have gained a bigger percentage. Okay, buying when the stock is undervalued will ensure higher dividend yield in the future as well. Okay, so
so how do you
let's say that company, yeah,
no, you
go
follow,
ahead.
you go ahead first. I think you have
Okay.
you haven't completed, right, your thought.
Yeah. So, for example, if let's say you are able to catch the stock on a lower value, any sequential dividend or increase in dividend would just make your yield even more attractive. Yeah. So gradual accumulation while the stock remains undervalued versus its peers. Okay. So, very importantly, that stock, as long as it's good for you to accumulate, but once it should pass a certain level where the PE ratio, has reached almost the same level with its peers, then I think, there's no point in chasing that stock anymore. Okay,
So
important that the
use
stock is consistently paying dividend.
you usually benchmark the PE ratio among
Yeah,
across the peers to see whether the company is undervalued or not, am I right? Do you calculate?
I look at a few things. The share price over the net asset value. That's the first thing. Okay, that's why when I look at it, I always use these metrics. Yeah. Whether now
So
this
if
one
it's below 3 times,
this one
is
3 times or 2 times is, if let's say it's below 3 times, it doesn't immediately means that it is undervalued. Why I say 3 times is because for my own measurement, if the stock is 3 times its net asset value per share, then I may not be interested to buy it at all, because why should I pay 3 times for its net asset value? But then again, this is not a universal rule. You remember previously when we talked about myeg.com.my, its share price over net asset value was very, very high. Okay, because it is a high growth company and everyone is piling in, in that company. Okay, but then that is why it depends on your nature of risk taking. Okay, for me, generally, I will look at share price over net asset value. If anything more than 3 times, okay, it doesn't mean that I will not buy that stock, but then it raises a concern. But if let's say that company's potential for growth, is 30, 50%, then I would think that the share price over net asset value for a high growth company more than 3 times, hey, it's quite okay for me, So that's why you need to measure it in context, and that's why normally I use a scorecard to dictate. Okay, if let's say if a high growth company may fail on this, but then its current ratio may be good, its debt to equity ratio may be good, its revenue growth is good, then you may have all yes but only one no. Then that more or less conclude my decision. Okay, but generally, okay, I will look at something that is less than 3 times its net asset value per share. Of course, if you want to be even safer, you can put it at 2.3 2.5 times, is really, when it comes to a KPI, it is your acceptance of the risk that set you, that allows you to set your own KPI, not necessarily that you have to follow mine. Yeah.
Okay, so do you calculate
Does that answer your question?
intrinsic value for the stocks? If yes,
Now,
what are the
I think
method?
intrinsic value for a particular stock, okay, will be such that, not necessarily the KPIs would tell you that it has reached its intrinsic value. Why? For example, because intrinsic is how investors value. For example, for 8.80 cents, okay? Because if we base it on its balance sheet and all those, it's something you will come across whereby, now, if let's say my own acceptance of an intrinsic value is when it's profit growth and net profit growth, so long growing very on a higher percentage, which means it's something, its valuation is quite rich, okay, because it's not translated in that even higher higher revenue or higher net profit, okay. Its balance sheet or net asset value per share is well priced in already, okay, and the PE ratio is reaching a rich valuation, and then its return on equity and PE ratio, matches that of the other peers. Then I would say that this company has reached its intrinsic value. But of course, it sometimes, for a person, that intrinsic value is based on your analysis. But other investors may value that company differently. Okay, so even though the company may reach its intrinsic value, people may still want to push money in. So whether you know when to sell or not, okay, is something that I would look at after it has meet my full valuation. Okay, that I think that, hey, it's quite it has meet all these specific targets already. Then I would see whether there's any more upside potential for the stock price. If let's say that's not, but then there's still investor piling, I may want to extend my period of holding. But if let's say the share price seems pretty stagnant, okay, and there's no real revenue and net profit growth that is quite substantial, then I may think that if the dividend yield is still very good, I may still hold on. But then if the dividend if let's say based on that dividend is not growing very aggressively, it's pretty stable, and that share price have reached quite a few multiples from my initial investment, then I may exit and find another company next. Value investing doesn't mean you hold the company forever. Although Warren Buffett likes to say, he himself, because he has so many billions of dollars, okay. But if let's say we are starting where we are right now, and we don't have that kind of hundreds of millions ringgit of holding power, then it makes sense for you to exit, make money, okay. Then you look for another investment, and then you make money from there again. Yeah. Does that answer your question?
Yes, it does.
So, okay. So that is why if you are holding a stock, when you're investing a value stock, you need to analyze the quarterly report consistently to affirm a long-term hold view, okay? Because sometimes people may buy a stock and think that, my initial analysis have shown that this is a value hold, okay? And you want to hold it, but then there may be certain things that happen. This may suddenly fall if let's say you do not really keep track, and then when it falls, you don't know for what reason. So sometimes when a stock, when the stock price fall, you must immediately know what's the reason for it. Okay, don't see that because it's falling, you immediately sell. Now, I want to share with you an experience. Previously, I own a particular stock, okay, and it has been moving up quite steadily, and then suddenly within that one day, it fell, I think, about 20%. Normally, when people see that 20% fall, they will say, hey, I better exit, okay? So for me, when I saw that fall, I read through all the news release, I check through the internet whether there's any report that's not, that is rumor or whatsoever, I checked through everything, but there's no news. It's just that the stock fell 20%. Then I decided that, hey, no need to worry. There's no negative news. Most probably it's just some institutional funds that is existing and so on, and no need to worry about it. And true enough, after that initial sell-off, just another 3 months down the road, it went up even higher. So that is why you need to know what's happening. Okay, sometimes when a stock fall, okay, you need to know the reason why. Okay, and just because you panic and you sell something which could be a good long-term investment, then you would regret later. Okay, so that's why it pays to look at the quarterly reports and analyze them to see whether that company is breaching certain KPIs that you have set. Okay, and if let's say it has breached those KPI, okay, on the negative side, then you will know that, hey, the risk is have increased for this particular stock. Then you can strategize maybe that you may not want to hold very long and may just exit with a profit simply because you do not want to take further risks. Okay, there must be an exit point sometime in the future because a stock may lose its appeal for further significant growth in price when valuation becomes too rich while earnings become stagnant. So this is a very clear indication that you should get out. Yeah. So Q&A session.
All right, we have come to the Q&A session. So if you have any question, you may write down in the question box, and then we will address it shortly. Okay. Now, in the meantime, let me wait. Let me take back the control from you, PC. Just give me a minute. Yeah, you may write down your question in the question box. All right. I guess you are seeing my screen now. So PC, all right. Here I would ask you a first question. So, how do you, when you say consistent, like how many quarters or years are we looking at?
Normally, I would compare it. I don't normally like to look at quarter-on-quarter comparison, mainly because especially certain like consumer product is very seasonal. Okay, so certain quarter it may perform well, certain quarter it doesn't perform. I normally look at the year to date and measure year on year. So that is when I know that versus last year, is there a growth? As long as there's a growth that meets the KPI, okay, or near the KPI, then I would take the risk and say, okay, I will hold on for the next quarter. Then the next quarter, I see whether is it a downtrend. If let's say there's a downtrend, is there a price movement? If let's say the price movement downwards is just a small percentage, then I may just hold on to the next quarter. But if let's say it falls again on the next quarter, then I may want to monitor more closely. So that is how I look at it. I normally compare it year on year more than quarter on quarter.
Yeah, so only previous year lah. Do you compare like 5 years or 10 years of growth?
Normally I don't look too much into so many years. Now why? Because I think right now a lot of companies, they are very dynamic in terms of strategies. Yeah, they may have acquisition in that sense, and any acquisition will actually boost revenue and boost the earnings. Okay, it is because the company is not static. They would actually acquire new product or acquire new technology. So that's why because things are very highly dynamic nowadays, I try not to look back on the past few few years. Okay, but in terms of share price, I do look on a more longer term to see whether there's is there any trend during, for example, last financial crisis, how much did it fall? Okay, should the next financial crisis, if it fall to this percentage, will it what price would it be? I would look on a share performance basis. Yes, I would look at maybe about 10 years kind of thing to really understand a bit on the trend. But other than that, I don't look back so much on 5 years. But if there's anything, the most I look back is maybe 3 years, because things changes very fast nowadays.
I see. So the next question is, would we better gauge the stock performance using earnings yield?
Now, I think anything that look at EPS or the inverse of it, okay, earning yields and all those, I try not to look so much into earnings, because as I mentioned many times, company can buy back shares, okay, and boost their earnings, okay, but then actually the profit actually never grow, although the earnings may grow. So that's why I often want to look at the bulk figure, okay, rather than just the earnings, because that can be easily manipulated through share buyback and so on.
Okay, so another question is, if the P ratio is low, is it considered dangerous to hold on that stock?
Now, if the PE ratio is low, you have to. That's PE ratio is not included in my KPI. If you look at my table just now, okay, PE ratio is something that I use to compare versus other peers. Now, if let's say that company has strong balance sheet, okay, it has revenue growth, okay, that matches or surpass its peers, okay, but it must be growth, yeah, not loss, yeah, okay. Revenue growth, net profit growth that surpass or just matches its peers, okay, and it has very strong balance sheet and its PE ratio is low, then I will be interested, okay, because apparently that particular stock may not have is under the radar of other investors. So then I would think that this is an opportune time to go in. But a low PE ratio is not an indication that it's high risk or low risk, but you will only know that when you measure against the peers, okay?
Okay, the next question is interesting. So if the price of a value stock fall together with a bad quarter result, but it is still selling at single digit PE ratio, should you sell or should you average now?
If let's say that particular this is when the sudden when that particular stock fall, is it as a reaction to a global sell-off?
It's a
okay,
bad
which
quarter
then there will be further downside.
Yeah, the price
Okay,
of the value
okay.
stock fall
If let's say it's
because
a
of
bad
quarter result.
okay,
But because it is
if let's say
still
it's a
selling,
bad quarterly result,
yeah,
yeah, okay. If let's say it's just a bad quarterly result, why does the, let's say for net profit, it becomes a net loss? Why is there a net loss? Now, that's why you need, if you have this indication, okay, you look at it, is that the reason, is the reason for that net loss due to a one-time write-off? If let's say it's due to a one-time write-off and it's not recurring, then I may want to, and provided that its balance sheet is very strong, yeah, after that loss, okay, but its balance sheet remains intact, okay, its plans for the future, okay, remains intact, but it's the earnings fall because of the net profit fall because of the one-time write-off, then it's, for me, I may accumulate, I may average down, okay, but assuming that loss is due to, a huge loss in revenue, then I'll be concerned. Okay, it means that that company is losing market share. If let's say it's losing market share and therefore it causes net profit to fall, then I'll be concerned. But if let's say revenue looks pretty stable, but there's a net loss, cause of a write-off, then I'll be able to I will say, let's see the next quarter. Okay. So
Okay.
you need to judge for yourself these kind of scenarios.
Okay, so the next question is, if we want to buy during the market correction, would you also look at the dividend as well?
Yes. Now, if let's say here we are on the topic of value stock. Now, value stock, if you want to, if let's say for you, if your target is value stock, you need to look for dividend growth, because like I say, value stock may have a longer period before you finally see the kind of appreciation. But if you are looking at growth stock, okay, there may be a sharp correction and you buy near the bottom of the market, or when that market is starting to recover, then you see multiples of gains. Okay, so it depends on your strategy, whether you are to go for value stock, that you want to look at the dividend yield may be important when there's a correction. Okay, so that you want to hold it for a longer period, that dividend yield then becomes important to you.
Okay. Yeah, the next question is also very interesting. So if a company is known to have future projects which will increase their revenue in about 2 to 3 years, so is it worth to get in now when the price is relatively cheap, or is it more wise to wait and see 2 years down the road before getting in?
Okay. It depends on your level of risk. If let's say there are certain development that's going to take place 2 to 3 years, okay, if that company is undervalued right now, okay, and you see that potential in the future, okay, it may be worthwhile to enter at this time, provided that, again, always look back on the balance sheet, because you are looking at a company needing to hold that company for a longer term period. That company must be financially sound for you to do so. Okay. And if let's say that company is not financially sound, but they have project, okay, for example, its debt level is very high. Okay, debt to equity is high. Its current ratio, is below 1. Okay. But then you are needing to hold it for 2 to 3 years, then of course your risk taking increases. Then your holding that long period of time, will that company eventually be under distress or not because of its poor balance sheet? Then it may not be fruitful for you to hold, to buy and hold. So always look back on the balance sheet for financial strength, especially you are holding for 2 to 3 years.
Okay, so the next question is before you sell any stock, PC, like how many negative year on year that result that you will wait before you really pull the plug?
I would normally look at by the second consecutive quarter. That's my most tolerant.
Okay, that means
Yeah, if let's say revenue fall, net profit fall for
for
2
2
consecutive
quarters.
quarters, then I may want to pull the plug. Because if already half year went by, okay, if you are still holding, then it doesn't mean that that company will certain to fail. But for me, I would find that, hey, 2 consecutive quarter is being hit like this, the share price, since buying, it's not even at the peak, but since buying at this level, it's already down, let's say 15-20%, then I may want to park my money elsewhere. Now, unless that company is financially sound and you still believe in that project or in that potential, then it's worthwhile to hold. Okay. Again, it's something that you need to balance your risk and reward understanding of both. Yeah.
Okay, noted. So the next question is, would you agree to a certain degree that the 4 big sharks, namely EPF, PMB, etc., continues to accumulate or buy in a particular stock which has low PE? What do you think of that? Would you consider it a value stock?
I think whatever stock eventually need to see institutional support. Okay, just like outside of Malaysia. Okay, they also have other sharks. Okay, if you call these sharks, okay, there's also other sharks. For example,
Yeah,
Goldman
I
Sachs,
don't call
JP
it shark.
Morgan, when they say this,
Call it shark.
yeah,
Yeah.
I mean to follow what the user say, because sometimes without institutional support, just the retail investor support is not enough, because okay, just want to share with you that the Bursa turnover, annual turnover, okay, I think it's around maybe $200 or less a year. But if you look at the US market, it's 23 billion US dollars. So that's why for that, the retail investors is very huge. They not only that, they have investors from overseas that are buying into their shares as well. So that is why in the US, the retail investors can actually drive the stock. Okay, but if Morgan Stanley or JP Morgan says buy this stock, you can drive even higher. But then in Malaysia, because the retail investor space is strong, it really needs institutional support to actually support a certain company that is growing and so forth, and that is when you will see price appreciation. So that's why it's very important that for you all to tune in into BYIC, expand the knowledge, so that when there's real large pool of institutional support, then the market will slowly disengage itself from 100% rely, a high percentage of reliance on institutional support. The retail investors themselves can actually move the stock, and that's why education is so important.
Okay. So the next question is, how do we decide how many percent of our investable assets should be?
Does that answer the question?
Yeah. All right. Can you hear me now, PC? Can you hear me?
Yeah.
Yeah, you can hear me, right? So the next question is, how do we decide how many percent of our investable assets should we invest overseas? Do you think it is a good time to do it now if I'm thinking of China? So from one user, attendees.
I think if you're looking at China, you need to be aware of certain risks, because companies, I myself have done analysis on quite a large number of China-based companies here, and sometimes their debt to equity ratio can be very, very high because they are very highly leveraged. It's just like every cent that they have, they must leverage a few times. So you really need to be careful, okay? And also, there's always a lot of questioning, from other so-called analysts who are on the short side. Normally, they come up with certain reports that condemn a particular company, and that company can actually lose its price by 50% in a single day, because they have found how they actually cheated on their reports. So if let's say you are investing in Chinese company, just be very careful. Okay, look into the auditors. Okay, is the auditor China based, or if let's say the auditor is from well-known names, okay, like PricewaterhouseCoopers, okay, KPMG, then maybe you will be much more the level of risk will be reduced much less. Okay. Now,
okay, so does the Chinese prepare their annual report?
China is something that is very fast growing. You can look into it. Okay. Actually, it depends on where they are listed. If Chinese companies are which are listed in Bursa, they would actually follow Bursa rules that have quarterly report. So, some that which are listed in Hong Kong, sometimes in Hong Kong they only have two reports only, which is the half-yearly report. But in between, they will actually come up with a profit alert or profit warning, to tell how the company is doing. So it really depends on that Chinese company, okay, where they are listed in, okay. But I think Bursa also have its fair share of some Chinese companies, okay. mainland China companies. So if you are interested in those, you can examine those. But like I say, do be very careful because most of them are very highly leveraged.
Yeah, noted.
And if let's say, yeah, if you want to spread your risk, okay, you may want to. Of course, China is fast becoming the #1 economy in the world. Okay, because firsthand, China's debt is not as although China private debt in terms of corporation, they are highly leveraged. Yeah, their debt to GDP of the private sector is 220 to 250 times the GDP. But it's public sector, the government in terms of debt to GDP is very well managed. It's at about 50 to 55% of GDP, debt over GDP. Whereas the US government debt to GDP is already 110%. Yeah. So in that sense, China will have that capacity to grow. Okay, but do be careful. Don't put all your eggs into the same basket.
Definitely. So thank you for the amazing Chinese outlook. So the next question is, how do we buy good value stock and not catching a falling knife?
At the end of the day, I think it's your level of risk acceptance. Okay, if always refer back to the balance sheet. Okay, look at its net asset value per share, whether at the current price is something that you want to pay for or not. Okay, then you look at its revenue growth, whether there is room for it to grow, and then if let's say all these meet your criteria, then you can actually buy. But there's no such thing as not being hurt. Okay, somehow or rather, people will get hurt when they overlook certain red flags or they become too greedy. Okay, when you are doing investment, it is not really a falling knife. I will put it is a swinging knife. Okay, so you can get cut both ways unless you are careful. Okay, so there's no 100% sure way to make money, but there is what you can do is to practice 100% due diligence in analyzing, in comparing versus other peers. Then your risk level would. Next question.
Okay, so if the revenue grew marginally quarter over quarter, but the net profit keep dropping by double digit due to higher expenses, and the trend may go on for many more quarters, would you buy to average down or cut loss immediately?
Okay, if let's say, like I said, I always put myself 2 quarters. If let's say consecutive quarters, expenses have been rising, but revenue stagnant, okay,
No,
and
in this
therefore
case,
it
the
impacts
revenue growth, but the profit drop lah.
Okay, if let's say revenue growth, okay, but profit drop, then you have to ask your very simple question. Any investors that buy into a stock, are they buying for the revenue or they are buying into the profit so that one day they get a dividend? Okay, because how people value a company is the profit, not the revenue. Okay, if a company can come up with so much revenue, okay, but it doesn't deliver any profit. Yes, I can tell you some investors will just chase the company to endlessly because they believe in the future, but that future could be a fantasy. Just to share with you, Tesla share has gone from I think 20 30 US dollar now to 200 over, and it has been losing money every quarter except one quarter since it started business. And right now annually it burns through about $2 billion cash. But then its share price is still at lofty level. Yes, there are some investors who believe in that fantasy. But then for you, okay, Whether you want to choose to believe in that fantasy or not is entirely up to you. But if you were to be more pragmatic in your approach, then you will realize that, hey, this is a very risky venture. So at the end of the day, it's your acceptance, your acceptance of the risk level. If you can accept it, then okay, you can watch what will happen in the future. Okay. But if you don't accept it, then you may want to cut your losses. Now, oftentimes when revenue slightly grows, but that's revenue, net profit keeps on falling because of high expenses, means something is wrong with the management. Okay. Because a management is supposed to address the expenses.
Okay. So
Okay. Does that answer the
yeah,
question?
I hope so. So it's not my question, it's the attendees' question. So, but I definitely think
Yeah.
that profit is very important to me. If I would answer this question, if the profit keep dropping when revenue grow marginally, profit drops, I would think that the management is very incompetent. Why would they always,
Yeah.
why would they not manage their cost in such a manner that the profit should grow in tandem with the revenue? So that's my view lah. So anyway, the next
Yeah.
question is, what is your view on the upcoming deadline for US debt ceiling? Is that something we should be aware of? I think this is your forte. Over to
Yes,
you,
you should
PC.
be. Yeah, you should be aware of the debt ceiling. Like I said, the US would run out of cash exactly at the end of September. So without a vote to raise the debt ceiling, okay, the US would actually, government employees will not get paid, and so on and so forth. But what is most worrying is that even if they manage to raise the debt ceiling, it's like kicking the can down the road. Okay, the US debt is already at 20 trillion. If since the Fed has increased interest rate by about 1% in the last 1 year, now over that 20 trillion is like, you need another 200 billion of debt to pay as an additional interest for that 1% increase by the Fed. So does it make any sense? Okay, so the US is it's printing money, keep on issuing bonds, print money, because they, based on the fact that the global trade is using US dollar, but that is going to be challenged. I just share with you something that I read recently, that China will soon introduce an oil futures contract that is priced in renminbi, not US dollar, yeah, that is priced in renminbi, and people can convert that renminbi into gold at the Shanghai Gold Exchange. Now, if you look at it, which oil exporters, would they believe in an ounce of gold, or do they want to believe in the US dollar that is backed by a mountain of debt? Now, the US debt, total public, private, household debt, corporate debt, everything lumping together, okay, right now is at 330 to 350% of US GDP. If you lump in the unfunded liabilities, which means Social Security, okay, Social Security is just like our EPF. Social Security and Medicaid, the total debt plus unfunded liabilities is 1,100% of GDP. How can the US ever be able to pay this off? So now they are taking money from Social Security to pay for their expenses currently. And that's why a lot of pension funds in US are now underfunded. So when it's underfunded, what will happen? They borrow even more money. Okay, so that's why the US debt is uncontrollable already. So whether they raise the debt ceiling or not, okay, it will just means that more debt to the US, and if the Fed increase interest rate, there'll be more interest to pay for the debt. And it's not going to end very pretty. I think sometime soon people will realize that the US dollar is worth exactly zero. Okay, since the inception of the Fed from 1913 to current now, the US dollar has lost 98% of its purchasing power. So that is the US dollar to you. So if China comes in with renminbi that can be converted into gold, that will pose a serious challenge to the US dollar.
All right. So it's flight of US dollar. Yeah. All right. So the next question is, can REIT be a value stock as well?
Yes, a REIT can be a value stock simply because it depends on that, on whether the REIT, when you buy in, okay, is it undervalued versus its peers with a steady dividend. Okay, now but a REIT, to a certain extent, price appreciation could be slower than normal other normal stocks, yeah, because a REIT is often confined by its the Securities Commission's rule, okay, or policy, that is gearing cannot be more than 50%. Okay, so they cannot keep on leverage, but then it becomes a very safe safe stock, in the sense that the company will that REIT will not run into excessive debt. But provided that particular REIT know how to combine, okay, using doing the right acquisition in the right market, then you can see quite tremendous growth, okay, in terms of its income level, and then which is then distributed as dividends. Yeah.
Okay. So can a value stock be blue chip stock?
It can. Now, assuming one day Nestle, price falls quite dramatically, and then everything is balanced up, its balance sheet becomes good, and although suddenly you may find that Nestle PE ratio and PE ratio is lower than the rest. Okay. And yes, it's a blue stock, but then now it's undervalued. They have gone through a house cleaning. Okay, then yes, it appears, okay, it meet the kind of characteristics that we have discussed earlier.
Okay. So just now you're talking about briefly about financial crisis, and that attendee asking about financial crisis. Like, how should we prepare for major crash if it does happen?
I think the one of the thing is that don't overextend your risk. I think the most important is, if you were to invest with money that you can afford to lose. Okay, doesn't mean that you can afford to lose everything, but then you can afford to hold for an extended time. Okay, now there are some may want to move into some you may want to move at certain so-called better dividend yield stocks, okay, so that if a financial crisis happen, okay, if that company all the while has been giving a good dividend, then okay, you are able to buy at a low price and enjoy higher yield. Now the other thing is retaining a certain pool of cash for you to move in when there's a crisis, so that you can buy stocks on the cheap. Now, one of the things is that sometimes when companies give dividend, yeah, especially when it comes to REITs, we often spend that kind of money, okay? But if you are really a savvy investor, yeah, you may want to keep aside the dividend as a pool of cash that allows you to go into the market rather than spend it all. Okay, so just from my book, Invest in REITs, if let's say you have a REITs that pays 7%, yeah, and you reinvest that 7% dividend back into another REITs that pay equally 7%. Do you know that if let's say compounded over a 30-year period is 960% return? So provided that REIT only increase in price, yeah, about 2% a year. So that's why it's very important for you all to set aside that pool of money. If you have the dividend, maybe if you can keep it substantial, you put it in FD in preparation for one day you can buy at on the low side. But sometimes whatever we have, we tend to spend, okay, without really making certain preparation. Okay, one of the other thing is that in the last financial crisis, what we saw was that the price of gold and silver actually went up. So I don't normally allocate you to invest heavily into gold savings or silver savings account, but set aside a small percentage of your portfolio, maybe 10%, okay, or 15% into a gold savings account or silver savings account. Because if let's say the trend repeats itself, okay, gold could because the next crisis will be even much more severe, because since the crisis, the whole world have added another tens of trillions of debt. So one of the things which you can do is actually set aside maybe 10% or 15% into a gold savings and so forth, so that when there's a crisis and the price double or triple, then you have another pool of money to actually invest. So there's a lot of things, but most importantly is setting aside a sum for you to enter on the low side. Yeah.
All right. Thank you, PC, for your excellent Q&A sessions. So yeah, for those of you who want to learn more, you can also join our next session on how to invest in turnaround stock. All right. So what's turnaround stocks? Turnaround stock are stocks that were in a bad shape, but after the new management came in, they turned around the company, and then the stock price is on the rise. So we'll share with you how to identify this kind of stock and how you can invest profitably in this kind of stock. All right. So date is next month, 3rd of October, Tuesday, and you may register in the link that I've sent to you over the chat room just now. So yeah, so hopefully we can see you in the next webinar. So thank you so much, PC, for your wonderful sharing today, and may all of you have a pleasant rest of the day. Thank you.
Yeah, thank you for tuning in, and thank you, Shane, for being the moderator. Good night.
Yeah,
Bye-bye.
good night, everybody. Bye-bye.